Right, good morning and welcome to today's third Thursday marketing meeting. This is our August edition. We have you today Brooks York, who is the Director of Producer Services, along with Sterling Smith, who is our Director of Ag Research. Mike Toohill is at a farmer meeting today, kind of going through what's going on in the area where he's at. But he did provide some slides for us, and Sterling's going to kind of walk through those with us. Did want to just kind of give you a heads up. What we do, we provide critical information that complements traditional insurance and private products to add farm revenue opportunities. We really want this to be an interactive conversation. So if there is something that you have a question about, we really encourage you to put those questions in our chat box that you can see down below. I'm going to go ahead and pass it on off to you, Sterling.
Christy, while Sterling gets that audio taken care of, I'll kind of kick us off a little bit. So the month of August is kind of a bizarre month. Historically, we start to lose that price volatility that we typically see in June and July. I don't know if you could really say that's the case this August. We had a WASDE report, and if you tuned in for that, Sterling really nailed it. He talked about how he thought that was going to be a market mover. And of course, that was last Thursday. We saw corn up 26 to 27 cents right off the bat. And then we've just kind of fizzled since then. And if you remember the market moving news in that WASDE, it was a lowering of U.S. expectations when it comes to yield, or the estimates by the USDA. Christy, if you want to click over and share my screen real quick, I'll kind of set the stage for what August has brought. I can go ahead. I'll just kind of share my screen. That's how the game's played. I forgot. Let's see. Let's share a screen here. Let's take a quick overview. You guys know that if you read the DMO and you listen to these third Thursday meetings, I'm big on overall supply and demand, and more so than the fundamentals of the day. I kind of like to look at where we're at. And just as a quick recap here, these are just a real simple Excel version of supply and demand. We've got in the green here, these are our supplies. So this is the corn that we have. In this case, I've got soybeans pulled up. This is the stuff we have in our bucket to feed out, to trade out. The kind of the pink area or tan area is our usage. And so our 2022 column here, these are columns related to the crop years. This is the crop that just came out of the bin here. If you can see my marker in 2021, 21, 22, that's the crop that's in the field, some estimates. The thing that the WASDE report did last week is it brought a yield down from 50.2, which was kind of the expectation, just a little off of trend, to 50 even on bushel per acre. And when we plug that in, along with the acreage estimates that we've gotten back in June and kind of a confirmation, we filter down. And if I won't bore you with all the details here, because this is some nerdy stuff, I like to look at it. It filters down for a total supply. Remember, this is kind of what we carried in from last year. It's kind of what our leftovers are in here, around 4.5 billion. And you can see down here our total use when we look at our crushing, that's our processing here in the United States. Our exports pretty robust at 2.2 billion. We see we've got a total use here of around 4.48 billion. And here is where it creates our issue. Our issue is our carryouts. Now remember, these are estimated for what we're going to have left over next year. Come down to a very, very critical number at 34. Now, Sterling's going to tell you here in a second that the market, through a couple different methods, is not going to let this happen. It's going to try to fight like crazy to maintain stocks. And he did a really good job of forecasting what those WASDE numbers were going to be. But he's going to tell you here in just a second why this 34 million left over at the end of next year is fairly unlikely, because the market is going to take action to try to revamp those supplies. When we look at corn, it's a little different situation. And we'll take a quick look at this. Again, the green, that's what we grow. That's our supply. That's what we've got physically on hand. The pink or tan down here is what we use. Okay, we use them in different methods on corn. Of course, they got ethanol. We got the exports. You guys know this. I've been through this a lot with you. But essentially, at a 92.7 million acreage number, we take the yield to 174.6. Now, it's interesting because you guys all follow probably the Pro Farmer Tour that's out there. I think it ends today. You know, the Pro Farmer Tour, I don't know what the ending number is going to be, but they're kind of in the same ballpark as USDA right now with what they've found. So who am I to say, who or any of us to say that it's off? It certainly looks like we've got some consensus that the yield on corn is not as high as maybe what we thought it was a couple of days ago. And of course, we're looking at this thing by a bushel or two. Who knows? It can change, but it's the best number we've got right now. So when we throw in 174.6 and we look at what we carried in from last year, I'm going to increase this carry in to kind of match up a little closer with the government here. We're going to take that to 1.2 billion. I hadn't done that. It's an interactive chart. You can see that we got a total supply of around 16 billion bushels of corn. And we come down and we look here in the United States. And if you guys follow Sterling's Facebook, okay, you know on Friday night, he is eating and drinking very well, okay? You will likely see a steak or a big amount of protein from Sterling if he posts something on Friday and Saturday night. Something got into him this week, and there's that song that I think that says "Only on Days That End in Y," but he had a picture of a drink on Wednesday on there, so I think he might be doing pretty well for himself through the week. But the bottom line is, this is based on how well we feed our animals in the United States and how well that demand is for meat here. And it's one of the easier things for us to forecast because it's fairly steady. It grows fairly steadily. In this case, we've got it at 5.6 billion. That may be a little on the low side, but that's where we got it pegged. We look at ethanol and we look at exports, the big E's right here. And I'm going to ask Sterling to talk to this a little bit later, and he's got some really good stuff prepared for you. Mike has passed some notes on weather. We got a pretty good meeting for you today. But these are the two probably most important items that we have to watch over the coming months. All right, ethanol. Years ago, Dr. Minert at Purdue, I don't know, some of you may know him, Jim Minert, and he put together a really good presentation about rallies that have occurred in the markets. And not rallies, it's really gross revenues that have spiked for farmers since 1900 to current day. You guys have seen this chart. I overuse it, so I don't want to show it today. I just want to tell you about it briefly. And he says, he starts off and he tells you there's 4 prolific years in regards to revenues on the farm. And he's talking to corn, but I think we can talk to beans. And we didn't grow many beans prior to the 1940s. So we can't go back that first 40 years and really look at beans. So we're looking at gross revenues on corn. And he'll say there's 4 prolific years, and they happen back to back to back to back. And it's where revenues are really good. And then he goes on to say, and these years, this event has only occurred 4 times since 1900. And you scratch your head and you're like, no, that can't be right. We've had some pretty good 4-year runs. And all of a sudden you start to look at a gross revenue chart, inflation adjusted, that the university's put together. And you'll see that right after World War I, you've got that nice jump. Right after World War II, you've got a nice jump. You've got a nice jump in the 70s. Some of your customers participated in that one. They're going to remember the 1970s as a great time for agriculture. And then most of us on this call participated in the one, really from 2008 to 2013. And when you go back and look at things, kind of tell you where I'm going with this one in regards to ethanol. World War II, World War I and World War II were somewhat unnatural demands. There was reparations made to Europe. We started to really export that. We started to build an appetite in Asia as Japan was rebuilt. Also, I'm going to skip the one in the 1970s for a second. We go to 2008 to 2012, and it was mandated. It was a little bit unnatural too. And if you remember, that mandate surrounded ethanol. And so we kind of had this spark in the market. It wasn't an organic demand that grew into a big market. It was something that was mandated to happen very quickly. And of course, we know prices rushed up. We also threw a drought year in the middle of that, but they came back down. The 1970s was really, in my opinion, the only true natural demand. A lot of stars lined up in the 70s to provide some good opportunities. I won't get into that. The reason I mention this with ethanol is, with the stroke of a pen, mandates can be lessened just a little bit. I think that if you ask people across the board, will something horrible happen to ethanol? I don't think anybody is going to lift any overall mandate, but they could certainly start to ease restrictions. We saw a tweet out of President Biden's office a couple of weeks ago when I was on vacation. Sterling thought firsthand, and it was, in 10 years, by 2030, actually less than 10 years, we want 50% of our passenger vehicles to be electric. Not a good thing for ethanol, okay? So we got to watch this ethanol number. Is it going to 3.5 billion? No, it's not. Is it going to 4.5 billion? It's likely not going to. Could it be lessened by 200 million bushels? It could be. That's something we need to watch. That hasn't happened yet. Exports. Can you believe the spike in exports? Now, I know this is nerdy stuff on here, Christy, and I may have lost some people already, but let's look at this export number. We're looking for continuation, and I'm just going to say it out loud, of Chinese purchasing of U.S. corn. We've got 2.55 billion bushels here. That matches last year. Check this out. Check how big this is. 1.778 billion from the 1920 crop year, and we've exploded, okay? Now, here's the challenge. The challenge is going to be a maintenance of this high number going into the future. I was fortunate enough. We've had some great guests on here in the past, Christy. If I'm not mistaken, I think Andre Gauger was a guest about a year ago when we started the Third Thursday meeting. Dan McNeil has popped in. They're both traders for Zeno Grain Corporation. I used to work with them whenever I was at CGB. And they've really got their pulse on the export market. And in speaking to them here recently, the concern is not China going away from the export market, but there is a concern of the maintenance of a 2.55 billion export program into 22, 23, 23, 24. It's going to be somewhat of a challenge to reach these numbers for physical space in China, and also competition coming from outside the globe. So can 100 million bushels be bought from elsewhere? They can be if they're available. So this number, we know, is going to start to tick down, or at least we think we know that, little by little. So when you look at this balance sheet, the concern today is not the ending stocks. The ending stocks create a bullish atmosphere. When you combine this with the bean, shortness in the beans, we've got an atmosphere for prices to be volatile. We've got an atmosphere to stay on edge. The fly in the ointment, so to speak, two things. Number one, we got to watch this ethanol. We got to be careful with what might happen with the pens. An executive order, anything like that, that could take down the mandate just a bit, not completely, but just a bit, is not a good thing for our markets. The exports right now, I think this 2.55 billion number, in talking to those folks, is low for the next year. They believe China will really step up to the plate. What can get in the way of this? And that's politics. We all hate politics day to day. And when I say politics, I don't mean Republican, Democrat politics. I'm talking about global politics. So, what could get in the way here? We see a lot of saber rattling of China towards Taiwan. What are the likelihood of something getting in the way of these exports? I think they're relatively low, but at the same time, that percentage kind of has ticked up little by little with some of the events unfolding that you've seen on the news this week. So I just wanted to kind of set the stage of where we're at overall. We're still on edge. We have a couple things we need to watch out for, the big E's, ethanol and exports in corn. Outside of that, it certainly looks like our customers are going to have pretty good opportunities. Christy, have we got audio situated for Sterling?
Well, can you hear me?
Yes, you're
Yes.
live.
Yes.
I'll stop sharing my screen, Sterling.
Okay. And if Christy would put up some slides, we're going to talk about weather a little bit here very, very quickly. What we have seen, obviously, the area north of me has got some pretty serious problems. Christy, do you have those slides?
Well, I'm trying.
So in the meantime, Christy has put some questions out there for everybody. And don't be hesitant to ask. I promise I won't use your name if you answer them. But towards the end of this thing, I'm really wanting to see which way the crowd is leaning. I think everybody thinks there's going to be some volatility in prices. I'm curious as to how the balance is. I want to know how many bulls and bears we've got out there today. So if you think, and like I said, this is just for fun, we're gonna craft some marketing strategies for corn and beans based on your thoughts. But if you think the market's really going to jump over the next few months, let us know on here. If you think it's going to go down, and if you just want to put up or down, that's fine. Like I said, I'm not going to use any names. I just want to use these to kind of sculpt some strategies at the end of the third Thursday marketing meeting.
Okay, and it looks like we've got some slides here. Christy, go ahead and let's go on to the next one here.
Are you seeing it?
Yep. And here is the situation that we're seeing with the weather and what we're likely going to see through the balance of the growing season. Essentially, the rich get richer and the poor get poorer. So areas in the east, and let's quantify that as being the area east of Davenport, Iowa, east of the Mississippi River, we're doing very, very well. Now, when you start moving west, the picture gets to be a little bit more mixed. And if we could pull up that drought monitor slide.
Oh, sure.
As you can see, this has changed week over week again, and I'll be talking about this in the export report today. As you can see, those areas of dark red have progressed into central Iowa, into that area between Iowa and Minnesota along that border. And there we're having areas where we're beginning to see severe drought. And this has changed over the last couple weeks. Why this is important, we're looking at corn fill in here. We're looking at pod setting and soybeans. And this is the time when the plants need the most moisture. And with this happening, this is probably going to affect yields. And when we go and guess yields, we can do a pretty good job with corn. Soybeans is a little bit different. You have to really, at harvest, we usually see soybean yields go up. When you harvest those beans, the crop gets bigger. This may be different this time because of the problems, particularly what I'm seeing develop in Iowa and southern Minnesota. We're going to see areas where we are going to have problems with soybeans. Now, if you go just a little bit west around here where I am, I went out and took some pictures of some suburban corn yesterday, and Christy's going to be sharing those with everybody later. And what I mean by suburban corn, this is 60 blocks from my house. In 2 years, this is going to be suburbia. And that corn was fully 3 feet taller than I was at least and looked magnificent. The soybeans were waist high, and they're going to do really well. We move out further further into Nebraska, most of that's irrigated, and we can expect typical yields. But when we go north, there's problems, and that corn is not going to yield. And if we move on to the next slide. And go ahead and go to the next one here. And there should be one with like 4 or 5 maps on it. This is a precipitation anomaly. As you can see, this confirms county by county where we have the problems. Again, both the Dakotas are not doing all that well, and particularly in Minnesota and Iowa, we are seeing continued problems with the vegetative index, which means the plants aren't green enough, they're not thriving. And if we move on to the next slide, here we can see crop conditions again in Iowa, Minnesota, South Dakota, we're seeing continued deep problems with crop conditions. And the thing about yields and crop conditions, when they start to drop, they very, very seldom go up, meaning they typically get worse. So that's setting us up for that next WASDE report, where we're probably going to be looking at yields for corn probably getting cut again, and yields for soybeans potentially could get cut. You know, as much as 1 bushel an acre swings that whole soybean balance sheet. Could we lose a bushel an acre due to problems that we see in Iowa? Absolutely. We saw what the derecho did last year. Dry weather can do the same thing. So where we sit with weather, we're going to watch it. What I picked up from my other meteorologists that I talked to is that the next couple weeks we're going to see cooler and drier weather. The good news is it'll be a little bit cooler. The bad news is we're expecting a little bit of rain here tomorrow, and we'll see that front go through. After that, there's no rain really in the forecast for the next 2 weeks. So those are the risks setting up coming into the next WASDE. And if you like, Christy, if you let me go ahead and share my screen, I want to talk about some other risks that we have that are setting up above and beyond just what we're seeing with the crop. And sometimes we have to think about the world outside and above and beyond the risks that we can see and that we'll create here. If we can see my chart here, this is a chart of the S&P 500. Now, if you've been watching the markets the last couple of days, as you can see right here on my chart here, and I'll make this nice and big so we can see what's going on, we had a fairly sloppy day before yesterday. Yesterday was a very rough day for the stock market. And as you can see, we've blown down through the short-term moving averages that we use when we're looking at commodities. Now, today's action, we came in and we were having a rough day, and maybe does this relate to something back like this where we see a smaller correction, or when we get past vacation periods here and we move into September, are we going to see additional stock market volatility? And that's really going to be one of the big questions. We have a bullish formation and bullish behavior in the grain markets, and this, as long as nothing from the outside tips the scale a little bit, we'll be all right. But if we have a problem where we see a bigger sell-off in the stock market, and I'm going to bring up a different chart here, this could lead to a risk-off situation, which often leads to a much stronger dollar. And along with that, that can lead to a bigger sort of correction. And then the areas we really need to be worried about with the stock market here, in particular, is this area right here where this purple line is, right here about 43.50, which we got close to that today, and we started doing a little bit better. But if we come through that, we could see a problem. We could see a potential 15 or 20% correction, and we have not seen one of those in quite a while, so in some ways we're a little bit overdue for that. Now, along with this, you need to think about the Fed a little bit, and there's all this talk of tapering. And what that means is the Fed comes in right now and they're buying up mortgages. They're buying up corporate bonds. They're doing this to keep interest rates under control. What they want to do is stimulate the economy. If this changes and they begin to cut this taper, and we had notes yesterday from the Federal Reserve meeting that caused the big sell-off yesterday, saying that they may start doing this as soon as September. If we do that, you may have heard the phrase taper tantrum. What happens is the stock market goes through not a serious correction, but a period of pretty good volatility, and this could create a very different atmosphere for us coming into the next WASDE. So that is something that I'm watching closely. The other item, and this is often a pretty good temperature of how the economy is doing, is the price of crude oil. Now, there's a couple schools of thought on this here. We're going to pop this up. As you can see, the price of crude oil has slumped noticeably and meaningfully. Now, when crude oil goes down, this creates a headwind for all commodities. There are things called commodity index funds that people invest in, and are they going to be looking for a bargain, or are they going to start liquidating because they're not making money? The second question is, did we see high prices and the oil companies begin to pump more oil because they're making money? Well, that was $7 a barrel ago. So I'm beginning to get a little bit concerned about that. If this is not actually economic slowdown and ideas that the COVID variant and things are going to cut down on consumption, and we're going to see a period of probably not like we saw in 2020 in the early part there. But I know when I talk to my friends in New York, you know, they're all masking up and they're all getting concerned that there's going to be another round of lockdowns and schools are going to have to close and things like that. So if we see that, that's something else that could throw basically a bucket of sand on everything else that we have going on. Now, we're going to talk about exports a little bit. Now, this line right here, number 25, where we're looking at exports, that was the export sales for soybeans today, 2.2 million tons. And that was twice the most bullish expectation that we were looking for out of this report today. So this is a very, very good number for soybeans. And quite frankly, the total number for corn right here, we saw old at 216, which again is a really good number for corn for this time of year. We don't see numbers that high typically, and another good number for corn as well. So that solid demand base that Brooks was talking about for exports, it's there. And barring any really frightful sort of global, macro global problem, which with this I'm talking about an issue with China and the big new concern, again, this is probably a low order of probability, but it's not zero. Does China do something about Taiwan? Does something happen there that could lead to a different kind of sanction that will make what Trump did look pretty minor in terms of a trade war? So that is the biggest global macro risk. I'm not saying it's going to happen, but I'm saying the risk is not zero.
Erling, if I can kind of jump in, I'll give you a little bit of some color commentary that that I received from some of these export traders. I mentioned a 2.55 billion corn number. I think in their heart of hearts, they think that could go up to as high as 2.8 billion in regards to corn. So I know you're talking about the prolific soybean demand. I'm kind of switching gears to corn, which is really even more remarkable. Now, the flip side of that, and it goes right along with what you're saying, is you know, could there be a little preparation for some political strife? And I'm in your boat. I think the odds of sanctions or something like that happening with China because of Taiwan are really, really low, but they are also at probably their highest percentage that they've been in a long time. Even so basically the threat there is you know, China has proven in the past. What was it you said about a year ago, that they had a giant ball of lint when it came to cotton reserves? I think in the past that's been an analogy that's been used. In corn, basically, we know that they are building up stocks as quickly as they can. Is that in preparation for some strife? We don't know, but they're putting themselves in a situation where they could reduce that export number in years to come significantly and not have a big impact on feed numbers.
Exactly, and China's obviously rebuilding their hog herd, but we did see in the last quarterly report that I got out, it is China, and we always have to look at these numbers with a little bit of suspicion. And while hog supplies are up, or sow supplies are up 25% year over year, we saw the first quarter where they actually went down a little bit. So are they cutting the aggressiveness at which they're rebuilding their hog herd? We'll see. One other thing, overall in China, we're seeing a lot of crackdowns. We're seeing a much harder line coming out of Beijing internally. So are they trying to establish a different tone, not only with the rest of the world, but with their own citizenry? There's no question about that. One thing to keep in mind, they also have the Winter Olympics coming up. So I seriously doubt if they're going to make any sort of aggressive sort of behavior. It will not be until after that happens. And with that here, we're kind of looking at corn prices, and you can see we're coming back off the lows, much like the S&P 500. So we are definitely seeing some shared risk, as it were, here, particularly with the grains relating to the global macro situation.
Christy, while Sterling takes a little break right there, I think we've had a few chat responses out there. You don't have to mention names, but we threw a lot of questions at you. If you remember, I asked if you were in one of those parts of the country where drought had really hit you hard, and does it have an impact on marketing? The other one is the bulls or the bears. Do you think that market's coming up or coming down? What kind of responses have we had so far?
We've had a response
muted.
from.
There you go.
Can you hear me?
Yep.
Okay, great. We've had a response from Indiana saying that it's been very variable. Say that 3 times really fast. Very variable. But they are expecting almost a record crop. Some will. That some may have production claims because of a lack of rain. Let's see, we have someone from Louisiana. They've been harvesting corn for about a week. Yields have been good, over 200 bushels. They've had rain the last couple of days that have shut some things down. We asked a couple questions about seeing a major volatility in futures and in futures prices over the next 6 months. And then what we thought would happen with corn as well as with soybeans. We have had a couple responses. The one is if they drop the yields again, I think we could see higher prices as long as the demand stays strong. And then the same with corn, corn and soybeans doing the same. If the demand stays strong, they hope to see higher prices.
Well, and this is just a fun little exercise out there. I'm on the line with farmers pretty much from the time I get up in the morning till about whenever I want to make it in the evening as I return calls. But I can tell you right now, farmers are, it seems like this, really, really bullish right until some of them look like they have a really big crop in front of them. And then they start to think, well, what if this market goes down? So we've got a complete mixed bag of opinions across the country. I've got some farmers that are extremely bullish. One farmer said, hey, you wrote about rationing. Price has to ration this thing. I'm ready for a rally. I'm going to buy call options on my contracts. That's a good thing. I had one this morning, and he says, you know what? I got out in the field, and I've got a tremendous yield, and we're all guilty of kind of judging things through our back door. There's no way this market can hold up. It's got to go down. Give me 2 strategies that work. So we'll talk about that a little bit at the end. But I appreciate the participation. Sterling, I'll let you get back on with it here.
Okay, and talking about being of 2 minds and getting responses all over the board, I picked up something from Bank of America 2 days ago talking about interest rates. Now, there's an old joke about talking about interest rates. Albert Einstein landed in the jail right by the Board of Trade there in Chicago. The first guy he met had an IQ of 180. And Albert says, well, that's great. We can talk about trading soybeans. Next guy he meets has an IQ of 160. Albert says, well, that's nice. We can talk about trading wheat. The next guy he meets has an IQ of 140, and he says, well, we'll talk about trading stocks. He meets another guy, has an IQ of 100. Says, well, we can talk about trading gold. The last guy he meets has an IQ of 60, and Albert says, well, that's nice. We can talk about which way interest rates are going. So I pick up this thing from Bank of America, and they tell me that interest rates in the next 6 months could go well below 1% right here on this 10-year note, or they could go all the way up above 2%. Well, gee, that's really helpful. So what I think that analyst was trying to convey, other than he's in over his head, is that we could be looking at a situation where if interest rates drop, that's going to be a sign of a lot of bad things have happened. 1, a serious stock market correction, or 2, an increased COVID problem, or something that drives money out of risk and into bonds. And that would probably mean money coming out of the grain market. And what we would see is we'd probably see prices come down, which would in turn globally, I think, being good for demand depending on what caused the break. By the same token, if we see interest rates go up, that's an indication of strength. that the economy is doing better and that our problems are behind us. And guess what? That demand for corn and soybeans probably isn't going to get rationed immediately. Eventually, if we take 2 bushels an acre off of that soybean yield, you're going to see higher bean prices, and that will ration and help temper that demand. And what we need to remember is the other vulnerability that we haven't talked about. It's August. Guess what? Those guys in Brazil are greasing up their tractors. They're getting ready to go, and they're getting ready to plant. So 60 days from now, our new risk is going to be how big is that soybean crop going to be next year in Brazil? And I've heard a number of 140 million tons, which is about 9 or 10 million tons more than they had this year, and about 20 million tons more than they had just 5 years ago. So
Sterling,
that would definitely tip the balance sheet.
Let me jump in there real quick. And we talk, we talk million tons, and it goes over our heads a lot of times. But when we talk in percentages out there, the expectation, and Sterling, you correct me if I'm wrong, on growth down there is generally like a 3 to 3.4% increase year on year, especially when we see these good prices out there. What you just indicated to me, if I'm not mistaken, and doing quick math in my head, that would increase that to what, around 4.5 to 5%?
Exactly. Well, this year, remember, we had a short crop. We had weather problems in South America that, obviously helped out the global situation. Are we going to have those weather problems again? Well, it's been snowing on coffee trees, so are we going to have normal weather down there? So far, it would seem like no. But again, it's weather, and we'll see where we are 60 or 90 days from now. But we are definitely looking at La Nina conditions developing. And if that does happen, that will create, obviously some weather volatility, and that will be good for prices. And if we don't see weather volatility, we could be looking at very big soybean and corn crops coming out of Brazil, which is going to give China some optionality about where they buy their crops from. But one other thing that I'd like to talk about here is the item that has actually been the bit of a leader here, and that's been the wheat contracts. And wheat in general has done very well. And if we look here, Minneapolis wheat is still holding above $9 a bushel, which is very good. And the European situation with wheat has degraded noticeably. We are going to be looking at materially smaller yields coming out of both Germany and France. And that is something that will, I think, keep this market supported. And if we can keep one of the three supported, that will be, something that will help us absorb some of this outside volatility that we may be looking at.
Sterling, I'm going to back up a little bit because you talk about keeping the market supported. I started this off with, a supply and demand table, and I actually got a text about my estimate on there. And again, they're just estimates, all right? They're all for kind of good fun. They're as good a plan as we can do at this time. But I made the statement, the market is going to work hard to make sure that 34 million bushel carryout is not where we're at. Okay. If you don't care, explain my statement there to the crowd today. Why will the market work hard, and in what regards will it work hard to make sure that's not the case?
Well, if we're going to try and tighten carryouts to where we see corn sub $1 billion, U.S. soybeans under 100, the market has two ways of adjusting. Prices go up or supply has to go up. When prices go up, normally that tempers demand. So that will work as a natural buoyant to where we won't be exporting as many soybeans, or maybe we're not exporting as much soybean meal, which we've done a tremendous job of this year. So that's the first thing. The second thing it will do is it will amp up production. And what that means is bringing more acres into use, planting more acres, seeing less prevent plant, seeing more acres coming out of Brazil. Now, if we have ongoing weather problems, that's something we can't necessarily control as easily. So what that will create is a situation, again, where the market will eventually try and shed these prices and move to lower prices as demand adjusts. And that goes back again when we look around the corner to next year, the year after, and the year after that. Where are we going to be with the ethanol? Where are we going to be with the biofuels? Because along with that message that 50% of the cars by 2030 are supposed to be electric, there was another message attached to it that by 2050, they want most of the jet fuel on the planet to be biofuel, which that would obviously be something that's good for soybeans because you need a heavier oil for that, and that's something you can brew out of soybean oil. You're not going to readily be able to make jet fuel out of corn. So that is another bigger, more long-term concern that we have. And the wheat kind of misses all of this. It doesn't really fall into that category. And particularly if we see problems in Europe, we could see exports globally tighten coming out of the Eurozone, particularly going into the Middle East. And that could create some new paths for wheat. And we could see maybe a little improvement in our exports, or we're suddenly going to see a lot of blending of that low-quality wheat.
Sterling, one question that I had posed to me through the week, and I'm going to give you my answer, and then I want to get your take on it. In regards to wheat, I'll tell this story, and it's one of those stories, you know, I probably overtell it, but I think it was 2008. I was a farmer marketer at the time, and I had my quotes up, and I was watching wheat, and wheat was in a runaway market. You probably remember how high Kansas City and Minneapolis were trading. And of course, I was watching the Chicago wheat market, as a lot of my customers at that time were soft red customers. And you'll go back in history, you can kind of find this day because it's an easy one to remember. I had a customer come by, and he popped in my office, and he said, "Is wheat up or down?" And I looked at him, and I said, "Well, it's down. It's down $1.20 right now." And I turned away from my screen, and I visited with him. And 20 minutes later, I turned around and I said, "Did I say the market was down earlier?" And he goes, "Yeah." And I said, "Well, it's funny. It's up 80 cents right now." And it continued an escalation up. And if I'm not mistaken, it hit almost $11 futures on the July. And I think it was probably a July 09, if I'm not mistaken. And we had this huge fluctuation. And what I'm getting around to is if you remember, and if you guys are farmers on here or agents, you'll remember that in 2008 the basis was horrible in a lot of cases. The basis in some cases was $2 under. Okay, Sterling, in regards to wheat, I had the question posed to me this week. I really like where wheat futures are at, down the road. I would love to take advantage of these, but I did these one time before in 2008, and I set futures at $8. And when I delivered, I received a basis of $2 under. What's the likelihood of something like that happening this year? And while anything is possible, it looks like this year we have a true demand market, a physical demand market for wheat. I think the odds of us seeing that disparagement between futures and the cash market are really low. So I think that your odds of receiving that basis that's far in the unders, that's a terribly low basis, is pretty small. What would you say to that question?
I would tend to agree. And here's a picture right now on the screen of Minneapolis wheat and its behavior in the early part of 2008. And as you can see, prices spiked all the way to $24.26 a bushel. Now, this was a futures market dynamic. There was particular problems. There were delivery issues in and around Minnesota, particularly in the Minneapolis area. There was some people caught trapped in the market, and that caused that derivation. Now, since then, there had been a problem with a thing called convergence, meaning the futures market representing what's going on in the cash market, and the two should, near contract expiration, on a national average, should converge. So the Chicago wheat in particular had problems with this. As there was a lot of fund activity. People wanted to catch a ride on the Minneapolis, hopped on the bus to Chicago. Maybe they did okay, maybe they didn't. That kind of depends. But what we did, the exchange put in a thing called the VSR, a variable storage rate, which helps control and contain the futures market from getting out of hand. That's the first thing. The second thing is we actually have a true physical market here. We don't have the wheat. And if you don't have the wheat, that's obviously going to have a different effect on basis than when you have a futures market anomaly. I would compare what happened in Minneapolis with the prices spiking up here to $24 very much to something what we saw with crude oil in February and March of 2020 when the futures market actually went negative. And these are anomalies, and I think this year we are pretty well insulated from that simply because, A, we have the demand, and globally, wheat crops, from here to Paris are not doing that well.
So in a nutshell, if you didn't have that concern and you're listening, it looks like from a basis level, a basis perspective, things should be somewhat normal to somewhat bullish over the next few months. And Sterling brings up a really, really good point there. Where do we grow wheat? Well, we grow wheat just about everywhere except Antarctica. So our wheat supply and demand situations, they seem to regulate relatively quickly, especially when we're in a low supply situation.
Yeah, absolutely. Absolutely. It's something, unless we saw, multiple years of consistently bad weather, which is not normal, eventually, that drought will bust. And that will obviously change the market. But for right now, I think we are in a good global situation, and basis should continue to reflect that. And this is a picture here of crude oil. Can you imagine what gasoline would have been at the pump if we stayed at minus $40 a barrel?
Sterling, this is going to be an aside in the meeting, but I think a lot of folks on here, and I know we've got a couple that actually have a brokerage license or have had in the past anyway. And I talk to a lot of brokers, and whenever crude oil hit zero, and they continue to watch the trade, even seasoned brokers were very, very surprised at a negative trade. Now, I know the answer to this one, but I'll let you answer it. How in the world can a commodity trade below zero?
Okay. And what we have to remember with this, when we buy a commodity or sell a commodity, it's not like buying shares of IBM. You are making an agreement to make or take delivery. And what happened was the COVID situation had become such that the airlines were shutting down all of their deliveries for jet fuel. And this created a backup in the market. So I own a futures contract, meaning I need to deliver on it. I need to send this oil to Cushing or Houston or wherever it needs to go. Well, when the tank is full in Cushing, the guy says, no, I don't want your oil. I have no place to put it. And it's crude oil. It's not something, you don't want to leave it sitting on a tanker because that is frightfully expensive. So what happened was there was no place for these futures contracts to make delivery because there was no capacity, no place to put the oil. And the delivery side of the market got pretty clever here and folded up their arms and said, we're not buying it. So you create a market that's falling apart. Now, where it became very interesting is that the CME agreed that, yes, futures prices can, in fact, trade negative. And they made this decision because this had never come up ever before. They made this decision to allow that to happen. So now you have a market going into brand new uncharted territory at the worst possible moment. So prices were allowed to completely collapse. And if you were savvy brokers, the front month was the price that went below zero. Everything else went down to $4, $5, $6 a barrel. And if you were brave and came in there and bought it, it worked out, and it worked out well. But that's how that can happen, because we have to be able to, at the end of the day, this stuff a lot of it has to be physically delivered. And if you have no capacity to deliver, that problem comes up. The exact opposite happened in Minnesota. There's no wheat to be delivered. It's trapped. We have logistical problems. We have all sorts of things going on, and that pushed the market into these sorts of overdriven situations. It would be very, very hard for something like corn or soybeans that, compared to crude oil, you don't have the same level of turnover. You don't have the same level of movement, and it would be very hard for that to happen in those markets. But in something that's particularly fluid, like crude oil, obviously it can happen. I seriously doubt it'll ever happen again, but we don't know.
Yeah, and you know, a couple things to note on that. The volumes were relatively small. Like Sterling mentioned, the hazardous material portion of that makes it really really difficult. So in that short amount of time, having been involved a little bit in like the barge market in the past, if you can imagine the few folks that were obligated for delivery, they're scavenging and they're looking for anything they can. They're looking for tanker barges. They're looking for rail cars. You can imagine what a freight did in that matter of time. It was crazy as well. Kind of coincides. It's a little bit easier to physically deliver corn, wheat, and soybeans to a market like that than it is a hazardous material. So that played a lot into it as well.
Yeah, and to the consumption, the whole movement is much slower in the grain market than it is. You know, you don't have super tankers you have a super tanker pulling up into Houston, and there's no place to put the oil. You have futures contracts tied to that super tanker. And what do? Well, you're stuck. You can't deliver it, and then you end up paying demurrage on that tanker, which, being in the physical market, you know about paying demurrage, Brooks.
It adds up by the day. That's right.
Literally by the hour.
We're kind of coming up on an hour here, and we don't rehearse these, folks. We're kind of on the fly when we do these. We have some points that we want to cover. How much before we get off here, Sterling? I don't want to take people too long. I want to talk about a couple of strategies to pick your brain on. How many more slides do you have for us?
Me? I don't have any more slides.
Well,
I play live here.
Right. So we're going to put, like I said, we don't rehearse these. So I'm going to put Sterling on the spot here. Are you ready, Sterling?
Yeah. Are we doing corn or beans first?
You know what? Let's just do corn. Corn's a layup. Okay. I'm going to give you a layup here. All right. Here's the situation. I've had a text come in, and the text came in. I've actually had three. All right. And you want to talk about farmers having extreme opinions on the market. The first text came in, and I want everybody to pay attention to this, because this is something that you can take back to your customer. All right. Okay. I get to choose the rules of engagement, Sterling. We have to use at least one derivative in two strategies on corn. All right. You have to satisfy the challenge. Okay. I've got somebody that thinks we're going to run out of soybeans. They think we're going to run out of soybeans. They think soybeans can be $15 to $17, which I think we got to admit is a possibility. But I'm going to switch gears, and I'm going to pretend it's corn. They think corn can be $7. Okay, I got one person that thinks corn can be $7. Now, I did get a text from somebody else that said corn is going to $4.50. And you know what? I wish I shared your certainty on that. We would probably not have to have a third Thursday marketing meeting next month. We'd probably all be on a beach someplace. So, Sterling, here's the challenge. You get two strategies. You have got to satisfy with the same strategy that person that thinks corn's going to $7 and that person that thinks corn is going to $4.50. I want you to listen again, because I know that we've got some folks on here that aren't necessarily in the marketing realm. We got to pick one contract or one strategy that your farmer can use or you can use on the farm that will satisfy you if prices go to $4.50. In other words, they're going to keep your nose above water and you're going to feel good about things. And at the same time, if you take that exact same action we think you're going to be pretty satisfied if the market goes to $7. Okay, Sterling, I've given you all of 2 minutes. Tell us what you got.
Well, you can't use just one derivative. We're going to have to use two, because if you think the market's going up, you're going to want to buy a call option. This is the easiest, simplest, most straightforward thing, and this is essentially for this. If you think it's going to $7, this is essentially a wager. And what you could do is you could buy this $6.50 call right now for December. It will cost you 7.5 cents a bushel. We'll call it 8 cents to make the math easy. That's $400. Now, if corn does go to $7 a bushel, you will make 50 cents. It should be worth somewhere around 50 cents a bushel, kind of depending on how things work out. So you would essentially make, in that case, you would make about 42 cents, or you'd make about $2,100 on that trade. Now, if you think corn is going to $4.50 a bushel, which I'm leaning, the $7 idea is a little bit more palatable, I think. But if you think you're going to $4.50 a bushel, you can come right in here. And I like to trade nice big round numbers. You can buy the $5 put. It's 50 cents off the market. You're risking about 10 cents a bushel in order to have it worth 50 cents. So you could make potentially 40 cents a bushel with that. Those would be the two simplest.
Let me jump in here real quick. From a trader's perspective, two really good scenarios. From a farmer's perspective, that regardless of what they think the market's going to do, they're going to have to turn their crop into cash in the next 90 days. Would you couple that call option? And I think you illustrated a 650, if I'm not mistaken.
That's correct.
Would you couple that call option with a futures only contract at the elevator or a short futures position, just because you have to go to the market?
You could absolutely do that. And if you were feeling real bullish, for every contract that you do at the elevator, maybe you buy 2 calls. Or for every contract, every 2 contracts you do, you buy 3 calls. Give yourself a little extra coverage. If you're feeling bullish, you can have a little re-ownership on the board here pretty cheaply. And there's a pretty good chance that even on one spiky day that you can move around that position and make some money.
So I just use a term on here. Futures only and hedge to arrive are essentially the same thing. So I got a comment here, what's a futures only? Some places we call that a HTA, or hedge to arrive. I even had some commentary from a friend in Iowa here on a chat comment that he likes that selling corn futures at the market and buying a call option that's a little closer to the money. That's something that you could do as well. I'll tell you who that works really, really well for. If you've got a crop in the field, number one, and you feel like you've got to take some of this stuff to market in the next 2 to 3 months, those are excellent strategies out there. So just something to keep in mind. Soybeans, Sterling, I'm going to switch gears here. Man, they're ugly today. We're seeing things down. What do? You got a pretty good soybean crop out there. In the last couple of years, the trend has been to move a few more of the soybeans to town as a farmer for cash needs. We've got bills to pay in November and December. A lot of folks do. We're going to have an important bill coming up here in September with the crop insurance premium. What do you do here on soybeans? Because I'm going to tell you, this one's not quite as easy as corn, or at least when I look at it, it's not. Give us some good advice on soybeans.
Okay, first of all, I'll reiterate what Brooks said about soybeans being ugly. We had a great export sales number, and we had another solid flash sale this morning of, 350, 400,000 tons of soybeans, some of it to China, but some of it to our friends in Mexico. So that creates, a situation where when we see the market down like this, that I don't like. I don't like seeing the market move the opposite of a pair of both really pretty good pieces of news. So if you're going to turn your soybeans into cash immediately, but you want to keep some bullish opportunities open, today you actually have a pretty good day to buy some call options. And looking here at November right now, and looking at the implied volatility here, these call options, and this column that I'm looking at right here is the implied volatility. It's how expensive the option is relative. to history. And when we were looking at the corn, they were plugging 27, 28 on the call options. Here on the soybeans, you notice we're down here in the 20s, so these options are relatively cheap. And if you think you can go to, see that $15 a bushel thing, what I would do is I would buy this $14 call right here for 17.5 cents, and I would sell, here, let me make this a little bigger here. Need more strike prices. There we go. So we buy the 14, we pay 17.5 for it, and we sell the 15 for 5.25. So you're in for 12 cents. You're in for basically $600 with a $5,000 final worth possibility. That would be, I think, the best way to do it. I think seeing beans really trying to get up much above 15, you're going to have some serious rationing issues at that point. And by the time this develops, you're going to have an idea about how well things went in South America.
I like that. If you wanted to extend that out to January, that gives you some protection on a movement through roughly the holiday season there, right after Christmas. Yeah. That's another option. You're going to pay a little bit more. I'm assuming, I haven't looked here, but I'm assuming the implied volatility is a little bit higher out there, and that's something you can do as well. That would apply for that customer that needs to turn that crop into cash relatively quickly. And here's something I'm going to mention real quick, Sterling, is options. We talk a lot about options. And when you've got time periods of low volatility and really low prices in general, so if we go back a year and a half, options just don't look very good. That they work, but you have to become a little bit more complex. When you see this volatile time period, when you see these higher prices, you can really go back to a textbook approach on options, and that's what I think a lot of folks need to do here. Don't be scared of them. And Sterling and I are here to answer these questions. When we say options, I know a lot of you guys have turned, you say, well, puts and calls, I don't understand them. My customers don't understand them. That's really the exact reason we exist here, is to answer those types of questions. So don't hesitate to get us on the phone or shoot us a text.
And going back here to your January play, doing that, looking at the implied volatility in January, the January options from that point of view, I mean, you're going to pay a little bit more for time, but you are actually getting a little lower implied volatility on the January.
Really? Well, that's good. That's good if you're a buyer. Yeah.
And these expire on the Januaries expire on December 23rd. So you don't have coverage for that big January report, but you're covered, well through all the way up through December. And usually by soybeans, we have a pretty good picture of things going on there. So.
Well, very good. We could go on all day on these strategies, and then that's actually what I do all day long. So if you've got those types of questions, let us know. If you find yourself in an area, I know Jason's on here from an area that is when we say variable, that's an understatement. He sent me some pictures of some crops that look really good, some crops that look really bad. If you find yourself or your customer in a situation where they've oversold, they're in a drought-stricken area, by all means, reach out to us. When I say oversold, meaning they've got delivery obligations at the elevator they can't fulfill, give us a call. We'll walk through a few tips on handling how to get out of those in conjunction with their crop insurance policy. And folks, if you're an agent on here, trust me, there's nothing you can do to build a relationship better with a farmer than help them out whenever they're in some trying times. So we would love to have those discussions if you've got them.
Yeah, and don't be shy. There are no bad questions, and I'll take as much time as anyone needs to explain exactly how each little moving part of this works, because once you understand, you're just basically buying and selling something in advance. That's all you're really doing. And once you kind of figure it out, it's not nearly as tough as it wants to seem to be.
Christy, we're an hour and 5 minutes in. I appreciate everybody hanging around. Good meeting overall. If there's not any last minute questions, I think I'll go on to my next task at hand. But with that, I'll turn it over to you.
We'll want to thank you all again so much. We really appreciate it when you engage with us and ask us questions and answer those questions that we ask. Really helps us to get a better understanding of where you're at and what we can provide for you. We want to remind you that we have our virtual crop tour going on right now. Make sure you tune into that DMO. That's going to be in there every day. We've got the survey in there. Answer those survey questions. It takes less than 2 minutes. It's a really quick survey, and you can be a part of our virtual crop tour. You can share your crop story with us. Also want to remind you that we have the WASDE coming up. That will be on Friday, September 10th. So watch the DMO. We should have those registration details in there soon. Next, coming up will be the third Thursday, which is this event in for September. That will be September 16th. We'll make sure you're putting that on your calendar, a save the date kind of thing. And then if you're not getting our DMO or any of our other marketing services, we encourage you to shoot us an email at marketinginfo@sampointernational.com. We'll be happy to sign you up for all of these. You want to know what those livestock prices are every day? We send that report out to you daily as well. So that's all I have. Do want to thank you all again for joining us. Brooks, Sterling, any parting words?
That September WASDE should be very interesting. We'll be past Labor Day, and I suspect all the outside markets will be moving around quite a bit, and we're probably going to see, another change in yields, and we may have some different export ideas. So we should expect to see a very good report, probably bigger than the last one we saw.
That's great. Brooks, anything from you?
No, everybody be careful in there as we start harvest. I know it's right around the corner, already started down in the Delta, and hope everybody gets along well with that. Got any questions, as usually, just give us a shout.
Well, thank you all again very much.